Well, I think if people are looking for really dramatic upside in the equities, they need to begin to pay attention to the silver equities. I think you're early. I think you always need to be early. If you and I are having a discussion 12 months for 18 months from now, the commodities that will be hated then, which is to say the commodities then that you'll want to be invested in, are platinum and palladium, which have really underperformed and will continue to underperform, and nickel. Remember that my investment thesis is to love hate, look for hate. And looking ahead, people are going to hate the nickel stocks. They're shutting down nickel production capacity worldwide. And I think once the commodity becomes really and truly hated, that it will provide the same type of upside, perhaps not as dramatic, as uranium did. Always look for hate.
In 2022, no one wanted uranium, and then it skyrocketed over 300%. Rick Rule says the next 10x move won't come from gold or silver, but from a metal investors absolutely hate right now, nickel. With global production being shut down and sentiment at rock bottom, Rule believes nickel is primed for a uranium-style explosion. This is your early warning, and if history repeats, it's always the most hated asset that leads the biggest runs.
I don't see a huge upside breakout in the oil market. I just see a stupidly good business where your current income from dividends finances your quest for long-term capital gains. It's the juxtaposition of risk to reward that I love so much about the oil business. Yeah, when a commodity goes from hated to tolerated, the easy money has been made, and a basket of uranium juniors is up 200 or 300%. It was impossible to talk people into buying uranium in 2022, and now that the price is up, everybody wants to buy it. I believe that there are structural changes in the uranium business, which we could discuss in a subsequent interview. It takes 15 minutes to get through the status of the uranium market as we sit. But the structure going from a spot market to a term market has profound implications for some uranium stocks, and they're all bullish. The idea that you have price certainty around the selling price of your product for 5 years or 10 years or 15 years means that uranium is unique among commodities businesses. This should, for the right companies, lower their cost of capital because of the revenue certainty, and provide unusually accurate forecasting around the equities. On a company-by-company basis, what I think it means is that structurally, the sure money is ahead of us, while the big money, or at least the easy money, has already been made. Well, I think if people are looking for really dramatic upside in the equities, they need to begin to pay attention to the silver equities. I think you're early. I think you always need to be early. If you and I are having a discussion 12 months for 18 months from now, the commodities that will be hated then, which is to say the commodities then that you'll want to be invested in, are platinum and palladium, which have really underperformed and will continue to underperform, and nickel. Remember that my investment thesis is to love hate, look for hate. And looking ahead, people are going to hate the nickel stocks. They're shutting down nickel production capacity worldwide. And I think once the commodity becomes really and truly hated, that it will provide the same type of upside, perhaps not as dramatic, as uranium did. Always look for hate. I think there is more to come, but I think the banking business is a uniquely good business. The temptation in the banking business to be stupid because of the leverage that's available is very high. There's a few things that can go wrong with a bank. One, you can make loans against assets that you don't understand well, because the assets themselves have performed well in years past, which does not necessarily make you a more knowledgeable banker. The second thing that could go wrong, and this goes wrong much more frequently, is time spread. Banks that buy long-term assets, long-term bonds or loans, with 6 or 7 or 8 year durations that are funded with short-term liabilities, which is to say overnight deposits. If the interest rate goes up, your cost of capital goes up while the capitalized value of the distributions that you bought goes down. This is truly an ugly circumstance, and this is what brought down the U.S. savings and loan industry. This is what brought down First Republic. This is what brought down Silicon Valley Bank, and is likely what brings down Community Bank of New York. There are a lot of institutions that have done that, which is really, truly, profoundly stupid. The prevailing deposit interest rate in the United States is about 4.15%. The prevailing lending rate in the United States, geared to prime, is some number around 8.5 or 9%. The idea that you can fund floating rate assets with floating rate deposits and enjoy a 400 basis point spread in the middle with 10-to-1 leverage, if you don't do anything stupid, is of profound interest to me. I mean, that's why at age 71, I'm starting another bank. Unfortunately, the temptation to do something stupid in the banking business, to employ excessive leverage and employ these time spreads, to get into lending sectors that are hot rather than lending sectors where you have specific expertise, is too high. And there is more sin in the community banking sector. You can expect more problems because there are more stupid bankers than there are smart bankers. We're coming into a 10-year period that will be marked by undersupply. We have underinvested in productive capacities around natural resources for at least 30 years. And this is a situation that can't be righted in the near term. It simply can't be righted. We need to replace one Bingham Canyon, the biggest copper mine in the United States, every year to maintain current production, and we're not. We're underinvesting in the oil and gas business, $1 billion a day in sustaining capital investment. And in the capital-intensive businesses, investment deferred reduces productive capacity. So there's absolutely no way in the world, absent a really ugly recession, that we don't begin to experience real production declines. You can have a production decline in a recession when demand decreases and not move supply. But irrespective of what we do, we're going to have supply constraints in natural resources. There is absolutely, positively no doubt about that. The race is going to be between production declines and economic growth as a factor, and then technology, the efficient utilization of resources, the ability to do more with less. My suspicion is within the next 10 years, global economic growth, global demographic growth, and supply shortages will outpace the efficiencies that we achieve through technology. And the consequence of that is that commodity prices will be particularly strong, and even more particularly strong relative to other sectors in the economy, like services and technology, that have outperformed natural resources for 40 years. I think you're seeing foreign central banks buy gold because of the politicization of the US dollar and the fact that they increasingly need mediums of exchange outside the US dollar, and they don't trust each other enough to use their respective currencies, the BRICS fraud notwithstanding. You aren't seeing retail purchase of gold in Western markets, with the exception of a few adherents, including some young ones like yourself. You are seeing increased private purchases of gold in countries that have traditionally been precious metals oriented. So as an example, India, the United Arab Emirates, Pakistan, Japan, China. And for all of our problems, I think you're seeing the same current account deficits with regards to Chinese government spending. Their trade surplus is still large, but their government deficit is increasingly worrisome. So I think young Chinese people are doing the intelligent thing. They're buying gold. Interestingly, they're buying gold with official government encouragement. The government is encouraging people to save in all ways, but to save specifically in precious metals, which interests me. I am now beginning, really 3 years ago, to see an increase in interest among some young Americans in gold. But I would note statistically, sidebar, by the way, for your listeners, I've now graded about 80,000 resource portfolios in 7 years, and hence learned a lot about the way people invest. And I pay real attention to the data. And what I've learned about people in the United States, young people in the United States who are gold and silver buyers, is that they're mostly either foreign born or first generation. which is to say the precious metals buyers that I've seen in the United States are Hispanic, or they're Arab, or they're Chinese, or they're Indian. I haven't seen a lot of Zacks in terms of young buyers, although I certainly hope to see more.
So to recap, Rick Rule just handed us the playbook. The next big wave isn't in the obvious places. While everyone chases gold and silver, the smart money is watching silver equities, and even more shockingly, nickel. Why? Because production is collapsing, investor sentiment is rock bottom, and history shows the most hated assets tend to deliver the biggest returns. If uranium's 300% run taught us anything, it's this: being early and uncomfortable often pays off the most. Now that you've seen what's coming, you'll want to know what happens next, because the next video we're dropping reveals the one financial move that could front-run the entire commodity supercycle. Click into it now before Wall Street catches on.